Hello, my fellow investors, and welcome back to another earnings video. Today, guys, we got NVIDIA, the most anticipated earnings of the quarter. And boy, did it not disappoint, because this thing absolutely crushed it again. In fact, it's crushing it to the point that it's getting absurd, right? So we did cover this one on the live stream, and we literally just did 2 hours solely on NVIDIA, which was absolutely crazy. Let's take a look at this company's fundamentals, guys. Of course, their earnings. And lastly, we're going to take a look at the discounted free cash flow. However, I want to take a look at both the 5-year and the 10-year, because while I currently did make the 10-year discounted free cash flow, unfortunately, I'm still having a hard time putting it into application because of the fact that it is 10 years, right? The numbers that the thing pops out are almost looks completely fake. However, honestly, they do kind of make sense in a way. So I'm going to show you guys both so that way you guys can make that determination for yourselves. Of course, before we get started, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. And of course, make sure to follow us on X as well. So with that said, let's get started with this analysis. So let's jump into their earnings summary. We got NVIDIA non-GAAP EPS of $5.16, beats by a whopping 52 cents, and revenue of $22.1 billion, beats by $1.55 billion. The funny thing about this $22.1 billion is that Mike literally said, I think, well, quote unquote, I think that they're going to do 22 billion. They were expecting, I believe, 20 billion, and they got 22, and Mike sniped that pretty well, honestly. So that's really interesting, guys. They beat by a massive number. NVIDIA Q4 EPS of 5.16 beats by 52. Revenue of 22.1 billion, up a whopping 265.3% year over year. Absolutely crazy. Now the shares, the shares are not down 3%. We're going to take a look at this in just 1 second. Now, looking at this from the itemized version, we can see data center revenue for the fourth quarter was a record of 409% from a year ago and up 27% sequentially. Gaming revenue up 56%. That came as a surprise, by the way, and flat sequentially. Professional visualization revenue was up 105% from a year ago and up 11% sequentially. Automotive revenue was down 4% from a year ago and up 8% sequentially. And, well, if we take a look at what they actually expect over here, we can't take a look at this. I'd rather take a look at this, though, in their actual earnings report. It's a little bit better formatted. But nonetheless, this pretty much summarizes the entire earnings. So let's take a look at, guys, their actual earnings, right? Their actual earnings report. Link is in the description below for all of you guys to see. I'm not going to go through all of this, but it is highly encouraged for you guys to take a look at this for your own investing benefits, right? So let's see what the CEO said. Quote, accelerated computing and generative AI have hit the tipping point. Demand is surging worldwide across companies, industries, and nations, said Jensen Huang, CEO. Our data center platforms is powered by increasingly diverse drivers. Demand for data processing, training, and inference from large cloud service providers and GPU specialized ones, as well as from enterprise softwares and consumer internet companies. Vertical industries led by auto, financial services, and healthcare are now at the multi-billion-dollar level. NVIDIA RTX, introduced less than 6 years ago, is now massive PC platform for generative AI enjoyed by 100 million gamers and creators. The year ahead will bring major new product cycles with exceptional innovations to help propel our industry forward. Come join us at the next month's GTC, where we and a rich ecosystem will reveal an exciting future ahead, he says. And they also, guys, do pay out a dividend of 4 cents, which honestly is absolutely nothing. But let's take a look at their outlook when it comes to their first quarter of fiscal 2025. Let me actually, if I can, zoom in a little bit on this. Yes, I believe I can. So we got NVIDIA first quarter outlook fiscal 2025 is as follows. Revenue is expected to be 24 billion, which Mike already said he thinks that he's going to do 25 billion. GAAP and non-GAAP gross margins is expected to be 76.3 and 77 respectively. GAAP and non-GAAP operating expenses are expected to be approximately 3.5 billion and 2.5 billion. GAAP and non-GAAP other income and expenses are expected to be in the income of approximately $250 million, excluding gains and losses from non-affiliated investments. And GAAP and non-GAAP tax rates expected to be around 17 plus or minus 1%. So there you guys have it. Now let's jump into the calculator. We're going to take a look at, guys, the 10-year calculator first, and then we're going to jump into the 5 one, okay? Just so that way you guys see the differences there. So let's do this right now. So guys, let's take a look at the calculator. We got the ticker for NVDA, market cap of $1.66 trillion, a PE of 89.09, current share price of $674.72. Just on the 1 year perspective, this thing is up an astounding 226.66%. And on the year to date, this is up, wow, 36.25%. 52-week low of 204.21 to a high of, and by the way, this is all-time highs, $746.11. Dear Lord, as of today, well, post-market to be exact, after earnings, they're up 9.1%. I'm rounding up to $61.22 to a price of almost $736. We are $10 away from being all-time highs, which that to me is just insane, guys. In fact, we recently had news of them saying that they completely crushed out Google when it came to market cap. In fact, we actually have it right here. NVIDIA overtakes Alphabet to become the third largest US company. This was as of February 14th. Granted, the stock has fallen and Google is back up above NVIDIA as well as Amazon, but yeah, at one point this thing, NVIDIA, was higher than that of Amazon and Google. So yeah, that's just completely insane that a company like NVIDIA is actually surpassed that of Google, which is a massive behemoth on its own. Coming back over here, we could see that they do pay the dividend of 16 cents, which honestly, I don't even know why this is the thing. Because if we take a look at this dividend summary, guys, this is a yield of 0.02. I mean, a payout ratio of less than 2, 5-year CAGR of 0.96, 0 consecutive years of dividend payment, ex-dividend date passed as of December 5th, payout date was on December 28th, they pay the dividends quarterly. This is another company, guys, that you buy for its dividend. You really don't. You buy this company because, well, they just did 266% on the 1 year perspective. So I look at this dividend and I'm just like, why? Why at this point? But they do pay it out, which ends up being $394 million with their current shares outstanding. And if we take the 10-year average free cash flow and we subtract this $394.56 million, they're left with $2.7 billion. And take the last year's free cash flow, they're left with $3.4 billion. These payout ratios are 10.36 and 12.77 respectively for the last year's free cash flow and the 10-year average free cash flow. So let's take a look at this net income, guys, on the 10-year. Yeah, I did make the 10-year calculator, and this gives a lot more light to pretty much investing in any company. So let's take a look at this. We got 10 years ago of $440 million in their net income. 1 year ago of $4.4 billion. That is an increase of 893%. And 2 years ago, this was when they were having the chip shortages, which explains why they gained to $9.752 billion, guys. Now, the problem with this graph is the fact that we're not getting the trailing 12 months. However, if we do jump to the trailing 12 months here on Seeking Alpha, yeah, $18.88 billion. That is absurd. That is going to leave this $9.75 billion in the dust. So that is the reason why I gave this thing a 60%. Mike gave this thing an 80% because he mainly just sees consolidation and he sees that $18 billion as an outlier. So that's why he's giving it an 80%. He sees consolidation with the 5, 3, and 1 year ago value right around here. Looking at now the free cash flow, this actually does look a little bit better. 10 years ago of $580 million to 1 year ago of $3.81 billion, increase of 557% with an average of $3.1 billion. Okay, so now the thing with this is the fact that, okay, this is consistently increasing. I would actually say at a pretty good rate from 10 to 3 years ago. We see the spike 2 years ago, that's fine. And then we see the drop. But this drop from 1 year ago, it's lower than that of the 4 and 3 year ago. And if we take a look at, once again, the cash from operations specifically, in the cash flow statement, we can see another $18.84 billion cash from operations as of the trailing 12 months. Again, this could just be an outlier. I get that they're doing a lot of stuff with AI. However, I don't know if that's going to be sustainable. So Mike gave this thing an 80%, the same thing as before. I'm going to give this a little bit higher because I do like the general trend of the graph, 70%. The revenue does look a lot better. You guys can see over here, 10 years ago, 4.13 billion, to 1 year ago of 27 billion. That is an increase of 553.12%. Now, again, this is looking a lot better. I wish that the trend would follow more along the lines of like the 10 to the 3 year ago. We see that massive spikes right here. However, the really big one comes once again in the trailing 12 months. If we take a look at the income statement and the total revenues right here, $44.87 billion. That went from 27 billion to 44.87 billion dollars, guys. So I look at this and I'm just like, I like the trend. The trend is better than that of the previous two. That's why I'm going to give this a 75. Mike gave it exactly the same as an 80. But man, that massive revenue spike is definitely going to be an outlier next year. Now, specifically for the 10-year calculator, I added the total assets as a reference so that way you guys could see how much the assets have increased as well as the liabilities. However, the graph in general for the assets minus the liabilities doesn't look too shabby, consistently increasing with a little bit of spikes right here. But honestly, that kind of does match the trend overall. Average total assets being almost 22 billion, liabilities of 8.62 billion, and a difference of 13.4 billion. I'm going to give this guy's 95, and so did Mike. Now, looking at the cash flow minus the liabilities. For the live stream, I did have the trailing 12 months. However, guys, I'm deciding to take that away because it's not really representative correctly because of the fact that it's based off of the one that the calculator comes up, right? It's based off of the cash flow that the calculator comes up, not the one that they're reporting. So that's why I kept it like this. So still, it gives you a pretty good verdict as to where this company is going. As you can see, as of 3 years ago, they are taking on liabilities. As of 1 year ago, they're at negative $15.3 billion. The average being negative $3.5 billion. You can see that they really didn't have much, especially they didn't have much 6 years ago, 5 and 4 years ago. Then they just ramped it up. But they are also investing a lot back into themselves. So can't really fault them for that. I'm going to give them a 70%. Mike gave them an 80%. Now, the shares outstanding. This one is by far the most controversial one because they are increasing shares in the 10-year, going from 2.3 billion to today of 2.46 billion. That is an increase of 8.5%. Previous year to the current year, it's a buyback of 1.6. I gave this an 80, Mike gave this a 90, and the reason why we're giving this really high grades, even though they're issuing shares, is because their share price is very, very high right now. So I'm actually happy that they are issuing shares in this moment because, well, if they were buying back with this kind of valuation, I would say that, yeah, it's looking, they're buying back really expensive shares. But that's just the way that I look at this. That's why I'm going to give this an 80%. I might give this a 90%. And lastly, cash and equivalents that currently hold $5.52 billion with an average of $2.86 billion. Now, the 10-year grade, I gave this thing a 73. Mike gave this thing an 83. The biggest discrepancies here would be that he's a lot more positive on the profit metrics as opposed to me. But even still, it's a passing grade for both of us. Mine is more of just like it barely passes. I would like to see more data when it comes to this, especially more data with the whole AI concept built already into them. So guys, let's take a look at this discounted free cash flow on the 10-year. This is going to be interesting because, again, the scale of 10 years is a lot bigger than that of 4 to 5 years, right? So we really can't use Seeking Alpha's, overall trend of, this forward revenue. We really can't do that. We could kind of do that for the 4 to 5 year one, but you really can't do that for the 10-year one. It wouldn't make any sense. So, man, it actually is a little bit difficult because it's just the scale of the numbers that are about to come out the second I put this in, it's kind of ridiculous. However, the way that I look at this is 10 years is such a massive long time that a lot can happen then. This company, guys, 10 years ago in 2014 was worth, in fact, let me pull that up for all of you, NVIDIA was worth around $4.50. That was in 2014, guys, 2014. So if in 2014 I would have told you, hey, in 10 years, the company would be worth upwards of, close to $1,000, $736, y'all would be like, what is going on? So please understand that what you're about to see right here when it comes to these numbers, it may look a little bit, it might take you back a little bit. But let's go on with this. So for the projected share buyback, this is in the next 10 years, right? So let's say that in the next 10 years that they have been issuing at around 8.5%. So let's say that they continue to issue at around, let's say -10, then let's say at around -8, right? So pretty much on par. And then let's say, assuming that the company continues to go up the way that they are, they will continue to issue a lot of shares. And then let's say at around -6%. I think that's perfectly fair. Now, here's where the problems. Sorry, I wouldn't even say problems, but here's where I guess the controversies start to come in. So this revenue growth, right? If you're projecting 10 years into the future, what this revenue growth would be. Oh man. Understand that in the past 10 years, the average growth has been around 55.31%. The average growth. I don't really know if I should take the average or the median. I probably should. Right now, I'm going to go with the average. I may change this up to the median, but for now, let's just use the average. So in the past 10 years, from 2014 to today, they have gained around 55.31% on average. So if we project the same kind of thing into the future, 10 years, well, I'm not going to say that they're going to do 55, but let's say that they do it around 20. Now, the moment I click out, you guys are going to see what's going to happen. So let's say around 20. Then let's say at around 25, and then let's say at around, well, let's say at around 30%. That's still below what they had done in the past 10 years. So with this, we get 395.35 to 895.72. Adjusting for debt, this comes up to 792.73 to a whopping price, guys, adjusting for debt of $1,800. Margin of safety of 5, 10, 15%, 673 to 1703. Yeah. So when I was doing this on the live stream, I got taken aback a little bit because I thought that it was still overvalued. But then I had to take it back a little bit in the sense that, well, if you look at these numbers, this is what you should pay for the company today, right? In order to get a 10% return, assuming that they do a 30% growth in the next 10 years. So assuming that they do a 30% growth and issue shares at 6% for the next 10 years. I look at this and, well, honestly, these numbers right here do make a lot more sense than that of the adjusted for debt one. But understand that that's the reason why these adjusted for debt ones are that big, is because they really don't have that much debt to begin with. And even these numbers over here, you can tell that some of these, like for example, when it comes to the 895 one for the highest assumption, this is looking like a pretty good price at 674. However, for these two, it's not looking too hot. So yeah, this is the problem when putting it into the future 10 years, is that you think, oh my goodness, 1800 adjusting for debt, that's insane. Guys, 10 years is a long time. 10 years, this company was $4, right? $4.50. Now look at it, right? It's kind of mind-boggling. So who in the world knows what this thing will do in the next 10 years, especially if they keep up this pace? But please understand the scale of 10 years, and that will make these numbers make sense. Now, I do also want to do this for the next 5 years because I want to give you guys a little bit of variety here. So I'm going to put the revenue growth to be the same, around 20, 25, and 30. And the predicted share buyback, meaning they're going to issue shares, I'm going to put it -3, -2, -1. Because if we take a look at this, shares outstanding, we can see that in the past 5 years, they've only issued around 1.73%. And putting a revenue of 20, 25, and 30, we get 73.16 to 164, and then adjusting for debt 148.48 to 203.49. Now a lot of you might be saying, well, why would it be lower with the same revenue growth for less amount of time? Well, it's because it's less amount of time, right? If you assume a 20% over the next 4 to 5 years, that 20% is compounded with less amount of revenue than what it did for 10 years. You get me? That's why it's coming out much less. So please understand that. And this is the one for the 5-year perspective. Yeah, it's a big difference. Obviously, with a different time horizon, your numbers are going to drastically change, right? I mean, even just a 5-year projection into the future changes massively, absolutely massively, because of that compounding kind of effect. So here you guys have it. Here is the NVIDIA discounted free cash flow for the 10-year as well as the 5-year. So tell me what you guys think. Do you prefer me doing the 5-year analysis, or would you prefer the 10-year analysis? I personally, I don't know. I would like to try the 10-year analysis a little bit more to get more practice with it with other companies like Google, Microsoft, Facebook, that I know pretty well how they function because I do them pretty much every time. Not that I don't do NVIDIA all the time, but NVIDIA has had such massive spikes recently that it's not smooth as supposed to, for example, Microsoft or Google, that I know that their fundamentals are smooth. So tell me what you guys think. I think I'm going to be using the 10-year for now. But nonetheless, though, that pretty much does it. They do pay out the dividend, guys, but I'm not going to bother looking at that dividend when it comes to a payout because it's like less than $2 for a year. So I'm not going to bother looking at that. So that pretty much does it, guys, for NVIDIA. Yeah, we had other earnings, yet NVIDIA was the only one that mattered. So there you guys have it. So again, we are live streaming every day because of the Rumble partnership. If you guys want to catch us live, you guys can follow us there. Link is in the description below. You guys can follow us on YouTube as well. Like, subscribe, comment on YouTube and Rumble. It really does help. And of course, follow us on X. So with that said, guys, thank you so much for watching. Peace out. We'll see you all next time. If you want to catch us live, we'll be live streaming live on Rumble at 7 p.m. Eastern. Peace out, everybody, and we'll see you all next time.